what are the like three buckets of money, and why is it important to have a little bit of all of them?
Yeah, so this has come up a few times because we've talked about it a few times, and so it keeps coming back around as I think a really good question. So the three buckets of money, as far as I'm concerned, are kind of taxable assets. Money you might have in a brokerage account, individual account, whatever you want to call it. Everybody's got different names for them, but it just means that if you make a change inside that account, it's taxable, and it can be a long-term capital gain if held long enough, right? And then you've got really tax deferred accounts, which would be like a traditional IRA or a 401k at work, or and 403bs if you're nonprofit, 457s if you're at a municipality. There's quite a few of these different pieces that you can set up. And that grows tax deferred, just means you don't have to pay taxes on it until you withdraw it. As you add money to it, you usually get a write-off. That money doesn't end up on your tax return. So, those have some advantages. And then the last one is kind of a tax-free growth. And specifically what I'm thinking about there is the Roth IRA or the Roth 401k. And so those you do not get a write-off when you put the money in. So you have to pay taxes on it first before it goes in. And then, but it does grow tax-free, for the rest of your life as far as that goes. And so I think the advantages of having some balance amongst all three, there's a whole bunch of issues. Having more taxable money gives you the advantage to have more liquidity because some of that money you've already paid taxes on. So if you need money to live off in retirement, you might be able to get at some of that without any tax because you paid tax on it a long time ago. And then any gains that you have are taxed at capital gains rates if you've held on to it for more than a year. And that can often be lower, well, it is lower than ordinary income taxes for each person. So it's cheaper tax wise. And so it just gives you the capability. Somebody says to me, "Hey, I got $100,000 left on my mortgage. I really want to pay it off." And I look at their assets and they don't have anything but a giant IRA, tax deferred account. And so taking 100,000 out to pay out the mortgage, you're gonna have to take out a huge dollar amount, maybe 175,000. It depends on their other incomes. And so you're going to lose all this money to pay off the mortgage versus if I had that in taxable account, I could take that out and maybe pay off that mortgage, satisfy that need, and have a lot lower taxes because part of that is going to be, already taxed money and part of that is long-term capital gain. So that's the advantage of taxable. Tax deferred, you get the write off, which is great, saves you money now, which is good. And it grows, tax deferred means that you can move stuff around. So we're more active in our tax deferred accounts, for example, because we don't have to put it on the tax return until you pull money out, right? Um, Disadvantage of tax deferred is that there is a required minimum distribution at 72. And I know a lot of people don't pay a lot of attention to that, but I do have clients that are now having to do that are now, 75, 80, 85, that have these big tax deferred accounts and they're having to pull a lot of money out. And it's causing them, especially single clients, to pay a lot more money for their Medicare. You can end up paying 2, 3 times more for Medicare on top of being in a higher tax bracket. So that can be really unwieldy. And it is the one big asset I see all the time is all of this money in this tax deferred arena. And I think people get carried away with that. And so then tax free, like a Roth, of course, if I can make 10% tax deferred versus 10% tax free, well, that's a huge differential. So pay no tax on it, have a lot of liquidity, can use that at any point in time, pull money out of it without having to pay any taxes. It's a really, really powerful assets from flexibility standpoint, but also there's no required minimum distribution at this point. So, you don't have to take any money out. And that's a great asset to let beneficiaries inherit because they can keep it tax free, maybe for life, depending on the beneficiary, or 10 years, again, depending on the beneficiary. That's much better than letting your kids, say, for example, inherit your giant IRA that they're going to have to take out over 10 years and they're going to get killed on taxes for that 10-year period. So all of those have pros and cons. And so one of the reasons to even keep tax deferred at all is because they might change the rules around the tax free side, right? So what you're doing there is you're diversifying the tax buckets, long-term capital gains, ordinary capital gains, tax free, right? All three of those are different tax treatments. If they change the rules, you have a distribution amongst those three, That seems very good to me, right? I mean, again, I'm on the other side of this. My average client's 74. I'm dealing with these distributions. I'm watching what happens. I'm seeing how this works, and I'm seeing situations that are working better than others. And so having those three buckets filled, adequately, I think is a great thing. And so if you're heading into retirement, pay attention, because this isn't something you're going to really notice as a problem until it's too late. When you're 75, 80, 85, all of a sudden you realize, oh man, I put everything I had into that 401k. I probably should have put some money in taxable, or put some money into Roth 401k or something along those lines, and trying to even this out, because now I'm getting hammered with this requirement of distribution. So that tax time bomb is something people just aren't aware of. And that's what we're trying to talk about here.
Yeah, and it's a lot of the issues with Roth is it wasn't available for a lot of
That's
people.
right. Yep.
Your income when they were introduced, maybe your income was too much,
Yep.
or
Yep.
your company doesn't have a Roth 401k. It's
That's right.
like becoming kind of common as
Yep.
now, but
Yeah.
when you're saving, maybe it's not around.
That's right. Yeah. The current group of 75, 80, 85 year olds, they didn't have a choice. They didn't have a Roth. They do have a choice now, and maybe even right after retirement, to do some conversions, but a lot of people don't know how that works. And now, more and more people are getting more education about that. We talk about it constantly. It doesn't work for everybody, but it works for a lot of people. And you're exactly right. They didn't have the options to put money into a Roth, for example. They probably did have the options of building up some taxable assets. That probably should have happened, maybe splitting a little bit of what they were saving into their 401k into something that was just a regular account. That could have happened, and a lot of people did. But those types of things, I think it's important for people to realize that there are three buckets, and that there's some advantages to filling out all three. Yeah, it's an interesting conundrum. I will say, though, I've had a lot of conversations recently with people that do have Roth 401ks. They didn't even know what it was. So that's what this is about. The show is to design people to have better retirements. Go ask your company if you have a Roth 401k, and consider what you should be doing there with your contribution, whether you should be adding some or all of your contribution to the Roth side of the 401k instead of the traditional side. And again, you and I have had those conversations with some of these clients, and they just don't know it exists. And so they go ask, and it's become more common. It's not everywhere, but if it is, it's worth looking into.